Hello, this is Collin. Today I'm going to analyze the stock market performance on Wednesday, October 11th, 2023, and what to expect from the upcoming inflation data on Thursday. Let's get started. First of all, let's take a look at how the major indices closed on Wednesday. The S&P 500 gained 0.43% to end at 4376. The NASDAQ composite rose 0.71% to finish at 13659. The Dow Jones Industrial Average added 0.19% to close at 33804. As you can see, the stock market started and ended on a positive note, but it was not a smooth ride. Around 1:45 p.m. ET, all three indices were in negative territory before bouncing back from their session lows. What caused this volatility? Well, there were several factors that contributed to the mid-morning slide. One of them was the geopolitical tension in the Middle East, where reports of Iran-backed Hezbollah making some provocative moves in the north triggered some nervousness among investors. However, Israel later said that those reports were a false alarm, which helped ease some of the anxiety. And another factor was the hesitation ahead of the September Consumer Price Index report, which will be released on Thursday at 8:30 a.m. Investors are worried about the inflation outlook after the September Producer Price Index came in hotter than expected on Wednesday morning. The PPI measures the changes in prices that producers receive for their goods and services. It's often seen as a leading indicator of consumer inflation, since producers tend to pass on higher costs to consumers. According to the Bureau of Labor Statistics, the PPI for September rose 0.5% month over month and 2.2% year over year. The core PPI, which excludes food and energy, rose 0.3% month over month and 2.7% year over year. These numbers suggest that inflation pressures are still elevated at the producer level, and that could translate into higher consumer prices down the road. That's why investors are anxiously awaiting the CPI report, which measures the changes in prices that consumers pay for a basket of goods and services. The CPI is closely watched by the Federal Reserve, and the market, as a gauge of inflation trends and monetary policy implications. The Fed has been saying that inflation is transitory and will moderate as supply chain bottlenecks and pandemic-related factors ease. However, inflation has been running above the Fed's 2% target for several months now, and that has raised doubts about how long the Fed can maintain its ultra-accommodative stance of near-zero interest rates and massive bond buying program. The market is currently pricing in a high probability of a Fed rate hike in November, which would be the first one since December 2019. A higher than expected CPI reading could increase those odds further and put more upward pressure on long-term interest rates. Long-term interest rates are determined by the market forces of supply and demand for bonds, as well as expectations about inflation and economic growth. Higher interest rates tend to weigh on stock prices because they increase borrowing costs for consumers and businesses, reduce future earnings potential, and make bonds more attractive relative to stocks. On Wednesday, however, long-term interest rates actually declined despite the higher PPI reading. The yield on the benchmark 10-year Treasury note fell 7 basis points to 4.59%, while the yield on the 2-year Treasury note rose 1 basis point to 5.5. This resulted in a flattening of the yield curve, which is often seen as a sign of slowing economic growth or rising recession risk. So why did long-term rates drop while short-term rates rose? Well, there are several possible explanations for this phenomenon. One is that investors are expecting a slower pace of Fed rate hikes than previously anticipated. due to concerns about the impact of higher energy prices, supply chain disruptions, labor shortages, and debt ceiling uncertainty on economic growth. Another is that investors are seeking safety in long-term bonds amid geopolitical risks and stock market volatility. A third is that investors are betting that inflation will indeed prove to be transitory and will start to cool down in the coming months. Of course, these explanations are not mutually exclusive and could all be partially true. In any case, lower long-term rates help support some sectors of the stock market that are sensitive to interest rates, such as real estate, utilities, and information technology. These sectors tend to benefit from lower borrowing costs and higher valuations. And then, on the other hand, the energy sector was the worst performer, dragged down by Exxon after it announced a $59.5 billion all-stock acquisition of Pioneer Natural Resources and a 2.5% drop in the deal is expected to create the largest shale oil producer in the US. But some analysts question the timing and the price of the transaction. The consumer staples and healthcare sectors also underperformed, as they are typically seen as defensive sectors that do well when the economy is slowing down or facing uncertainty. So, what can we expect from Thursday's CPI report? Well, currently the consensus estimate is for a 0.3% month-over-month increase in headline CPI and a 0.2% increase in core CPI, which would result in year-over-year rates of 3.6% and 4.1% respectively. These numbers would represent a slight moderation from August, when headline CPI rose 0.4% month-over-month and 3.7% year-over-year, and core CPI rose 0.3% month-over-month and 4.3%. However, these numbers would still be well above the Fed's 2% target and the historical average of around 2.5%. Therefore, they are unlikely to ease the inflation concerns that have been plaguing the market and the Fed. In fact, some analysts think that the CPI report could surprise to the upside given the persistent supply chain issues, rising commodity prices, and strong consumer demand that have been driving up costs for many goods and services. For example, Goldman Sachs visited into the Canadian film machines. And then in the second devices, which created very clear inside, they expect the headline CPI to be marginally softer than consensus at 3.55% year over year versus 3.6% expected. They cite several factors that could contribute to higher core inflation in September, such as a rebound in airfares after a sharp decline in August. A further increase in used car prices due to low inventories and high demand. A rise in apparel prices due to higher input costs and seasonal factors. Pickup in rent inflation due to strong housing demand and limited supply. A boost in medical care. Inflation due to higher hospital services prices. On the other hand, they expect energy inflation to moderate slightly after a large increase in August, reflecting lower gasoline prices in September. Of course, these are just forecasts. They could be wrong. The actual CPI numbers could come in higher or lower than expected, depending on how various components behave. And the market reaction to the CPI report will depend on how much it deviates from expectations and how it affects the outlook for Fed policy and economic growth. If the CPI report comes in much higher than expected, it could trigger a sell-off in stocks and bonds, as investors would fear that inflation is getting out of control and that the Fed will have to tighten monetary policy more aggressively than anticipated. If the CPI report comes in much lower than expected, it could spark a rally in stocks and bonds, as investors would hope that inflation is indeed transitory and that the Fed will be able to maintain its accommodative stance for longer. If the CPI report comes in close to expectations, it could have a muted impact on the market, as investors would already have priced in some degree of inflation moderation. In any case, investors should be prepared for some volatility around the CPI release time and pay close attention to how different sectors and asset classes react. That's all for today's analysis. I hope you found it informative and helpful. If you did, please give this video a thumbs up. Subscribe to my channel for more financial insights. And don't forget to hit the bell icon so you don't miss any of my future videos. Thank you for watching, and I'll see you next time.